Hi, everybody, and welcome to the latest episode of the Viking Chats podcast. I'm delighted to be joined today by our first US guest, Mr. Neal Bawa. Neal, thank you for joining us today.
Well, thanks for having me on the podcast. It's actually very exciting to be on a UK-based podcast. I think this is also my first UK-based podcast.
There we go. So, look, for those out there, with all of my guests, I like you to, in your own words, give a bit of a telling of your journey to date. You can go back as far as you want. But fundamentally, obviously, really interested to see how you got into property. You and I talked about that. That wasn't where you started, and kind of where you're at now, and what your kind of key objectives are at the moment. And then from there, we're going to drill down because there's some really fascinating stuff that I've read on your website and about you. So I'm really keen to drill down into that. But before we do that, for our UK audience and others listening abroad, tell us a little bit about you and your journey to where we are today.
Sure. So I'm a technologist, computer science degree. Data science is an area of interest of mine, sort of an amateur data scientist, if you will. Most people get into real estate either because, they have some family that's in real estate, or they get a fix and flip, or maybe they buy a rental property. For me, I got into real estate in reverse because my first real estate experience was to build a campus from scratch in 2003, 2004, an office campus from scratch for my tech and healthcare company. And that introduced me to real estate. I mean, until then, I was just, in Silicon Valley running a company with, 100 plus employees and not really thinking about real estate in any way except for owning my own home. I live in California. I call it Taxifornia. And so, big fat tech salary. I'm paying 50% of my income to the IRS. And when we built that campus, I was just shocked by how much of a difference that would make to my take-home income because of the wonders of depreciation and other benefits that you get from real estate. And that sort of opened my eyes to real estate, though I have to say I didn't jump in immediately. I didn't actually buy my first rental until 2008. But it sort of opened my eyes to real estate. I'm on record for saying something, and this is a joke, that real estate is America's best and authorized tax scam. And that, I said that before I understood that depreciation is actually a legitimate tax benefit, so I didn't understand it. But I think the joke sort of goes to make you understand just how stunning real estate is, especially when you look at US law for taxes, in terms of deferring taxation, mitigating taxation, and building wealth. And so over time, my journey in real estate started from 2003. So now we're in the 23rd year of that journey, with about half of that being sort of a full-time journey with, me having investors, and the other half just being, me growing my wealth.
So, I mean, really interesting, because I'd say at the moment in the UK, we're probably finding the opposite on tax with property, particularly in residential property at the moment. The government here has been closing or getting rid of a lot of tax benefits and tax loopholes to investors. Part of that has been driving a change in the demographic of landlords, trying to get landlords to move away from being individual, singular people landlords and actually forming companies. So some of the changes don't apply if you become a company. But yeah, interestingly, there's been quite a lot of increases to capital gains tax, removal of things that you can write off. So it's really interesting. But what you said with the US, that doesn't surprise me tax wise.
Donald Trump is a real estate developer. Most of his wealth is tied up in real estate. So there is this bill that they passed called the Big Beautiful Bill. You may have heard of it. And the Big Beautiful Bill bought, expanded opportunity zones, which is a very large real estate benefit, bought back 100% bonus depreciation, which is a very, very big deal. When you're buying a building, if you could basically depreciate a good portion of it in year one, instead of waiting 27 years to depreciate it, obviously you'd be more likely to buy it because you get massive tax benefits in year one and write off a lot of your taxes. So those kinds of things. And then yesterday, right, one day before we're doing this podcast, he basically said, I want Fannie Mae and Freddie Mac to buy $200 billion in single family loans. And when Fannie Mae and Freddie Mac buy $200 billion in single family loans, that absolutely will cut interest rates. It'll reduce interest rates dramatically in the US for single family. So he's always looking for ways to basically boost the real estate economy. Obviously, that benefits of him because he's got billions of dollars of assets himself. But in general, I think he has a very strong belief that a strong real estate market is necessary for a strong economy. So it goes beyond, his personal gain. I think he has very strong beliefs about that. So, we've got at least 3 more years left of Trump. So we expect the real estate market to benefit from some of the stuff that he's doing or has done or is talking about now.
Sure. And so let's go back. That was quite a fascinating first experience in property, building an office campus as your first endeavor into property. Now, I'm a big believer that we learn generally a lot more from our mistakes than from our successes. What were some of the biggest kind of mistakes you learned on that first project?
So firstly, it was a great experience because there were no investors and no bank, right? So those are the two things that you're, very afraid of, making mistakes on. So we made a huge amount of mistakes. And I can tell you one mistake that cost us about $800,000, right? And it was such a minor mistake, but it was so huge in terms of the losses. So we were building, on one side, we were building conference rooms and sort of sales offices. And the other side, we were building classrooms because we were a tech and healthcare education company. And so as you can imagine, a classroom, when you're building it, you look at the size of the desk. So let's say you have desks that are 5 feet wide. And so you want to build 5 feet multiplied by, let's say, 4 desks abreast. So that's 5 multiplied by 4, that's 20. And then you want to have an aisleway probably in the middle or on the side, right? So for people to walk through and get to their desks. And then you want to have the walls. Well, in my case, I did the design work and I said, okay, I'm going to have four tables in each row. So that's 20 feet. And then I'm going to have a 3-foot aisleway and I'll leave a few inches in there. Well, the way that the diagrams were written, I didn't understand that I had to also factor in the 6-inch thickness of the walls in there. I didn't count that in. I said, okay, well, the developer is going to, the builder is going to do that.
Whoa.
Exactly. I'm just looking at my portion of it. And it's like, no, you got to count the 6 inches for the wall in there. So I ended up with the room being 3 inches narrower. And so when we basically went in for, fire code submissions, we had already put in all of our studs, these metal studs that basically hold up the walls. And the fire inspector comes in and says, oh, well, this aisleway is 3 inches narrower. So basically now we had to rip out 250 feet of studs and move them 3 inches. Jesus. And that cost us $800,000 to do.
Wow. So yeah, some of those lessons. Now, obviously you talked a little bit about your journey. Before we talk too much more, I'd love for the audience just to frame a little bit more about where you are now. So can you tell us a little bit more about the real estate kind of empire that you've built and what you look after now and the overarching kind of strategy that underpins that?
Sure. So, the value of the assets goes up and down as you buy stuff, you sell stuff, and also the market has actually been trending downwards in the last 3 years because interest rates in the U.S. went up, tremendously. So the value of the assets went down. 600 million-ish in assets. I have 1,300 separate investors that have invested 300 plus million, 350 million, somewhere in that range, for these assets. And most of the assets are apartment type assets, large apartments, 100 units, 200 units, 300 units type of.
How many units does that equate to? Just ballpark, obviously.
How many units?
Yeah.
So typically, my projects are about 100 apartments or 200 apartments or 300 apartments. Those are sort of the bulk of them, even though I have some projects that are smaller, as small as 48 units. But typically, I try to buy or build somewhere between 100 and 300 units in a single project, right? So, and that would mean that if I'm building something on the lower end, it might be worth 20, 25 million US, and on the higher end, it might be worth, 100 million US.
And you primarily to sell, or you retain and let and manage?
We have two different divisions of our business. One builds, so we basically buy a piece of land and entitle it and zone it and permit it, and then basically go vertical and build it out and then fill it. So that's one division. And the other division basically buys buildings that are built in the 70s and 80s, and then buys and refurbishes or rehabs them and increases the rents. So two completely different businesses, but they're all both under the same umbrella.
That you're keeping the assets and letting them out as a revenue generating portfolio primarily?
Yeah, they're usually a 5-year business plan. So if you're buying, then you're buying it and then you're improving it over the first 2 years, and then you're letting the revenue increase for the next 2 years, and then the 5th year is sort of the sale year. If you're building it, then the first year is all zoning, permitting, entitlements. The next 2 years are construction. The 4th year is lease up, and then the 5th year is stabilization and sale.
So, look, let's start talking about something. So you talked about your background in tech and software, and your kind of passion, as I think you kind of very humbly said, as a kind of amateur data scientist. Right. I think you would argue where you've got to now, I think you've definitely moved out of that amateur category. But for those listening, how do you leverage data and tech to identify opportunities?
Sure. So when I started looking at real estate in 2008, right? So luckily by 2003, my taxes were going down because of, the office buildings that I mentioned. And so by 2008, I'd gotten to the place where I had money in the bank and I wanted to spend it. Everyone else was telling me that this was the worst time to invest in real estate. But when I was looking at it as a technologist, trying to do my research, trying to crunch numbers, to me, it appeared like it was the best time in 100 years to buy real estate. And so I would go and explain my thoughts to people, and they would basically say, you're really an idiot. I mean, you're a first-class idiot.
Was this pre or post everything kicking off in 2008?
2008 is when everything was kicking off. So, the news was all bad about real estate. And right. Here's me basically saying, look, this is a great time to buy real estate, and everybody else saying this is the worst time ever to buy real estate. Everything is crashing. And I'm like, no, you don't realize that the values are basically going to crash to the point where you'll be able to buy a home for 1/3 of a replacement cost or 1/5 of a replacement cost. And nobody was really listening to me at that point in time. So I became obsessed with the idea of finding like-minded people that wanted to use data to sort of make their decisions rather than all the bad news that was on TV. And so I opened a meetup group, meetup.com, basically a way for people to get together. Luckily, my business had large, conference rooms and classrooms, so we basically used those. And we established a meetup around sort of the data science of real estate. What are the sort of things that people look for in real estate, in data science? What should we be measuring? And how much should we be measuring? And once we measure it, what's a good range? What's a bad range? Things like that, right? So we started getting together with some other people. Luckily, I'm in Silicon Valley. I mean, if you throw a rock, you're going to hit a technologist. It's going to bounce off and hit another technologist.
Yeah, you're not short of people with technical.
There's lots of geeks, right? There's lots of people that like numbers, and so it's a great place to be in if you're looking really to look at real estate almost as a technology and try to apply data to it. So what we did was we started looking at what are the things that swing real estate profit the most, right? And this is universal. It would apply just as much in the UK as it does in the US. And what we found was that when you take large amounts of data, and we were gathering tons of data, mining it from different websites like Bureau of Labor Statistics and Zillow and Trulia and Redfin and places like that you can gather this data from. What we found was it was basically job growth, population growth, income growth, home price growth, and crime reduction. These were sort of the big five. And you might say, well, yeah, there's obviously things that you're missing from there, like quality of schools is obviously a big deal. And what I would say is no, not so much, because if you factor in these five,
quality of schools, right, and a neighborhood improves, the value
exactly, the values go up, right?
Schools, you get wealthier people's kids going.
Exactly. Right. So it's sort of a recursive effect. But bottom line, what I found was these five were actually bigger than the value of schools because they were
precursors.
I was ending up with the same set of cities, whether I had these 5 or if I added in schools, I would just still end up with the same cities. So what I did was I said, let me focus on the big 5, because these big 5 are basically telling me these are the big 5 that are in, swinging real estate profits the most. So, once again, job growth.
Build some bots that went out and scraped these sites, or did you recruit data analysts, or did you integrate with their data? I mean, do they have open data sources, a lot of those?
So most of the time, I hired a Ukrainian hacker, and he would write, scripts, software scripts in a language called Perl. These days we use something called Python, but back then we used Perl, and they would basically scrape data from the Bureau of Labor Statistics. There's job websites in the US. So what we were trying to learn is this: what makes home prices go up in a city faster than any other city? So my question is, if Kristjan and I are talking, and Kristjan's saying, well, Manchester is the best in the UK for real estate investment, I'm saying, no, it can't be Manchester. It's got to be Leeds, right? And what is the basis on which we're arguing? Is Manchester better than Leeds? Why do home prices go up better faster in Leeds than they do in Manchester? The question is, we were trying to basically find data and say, let's correlate this to increase in home prices. Let's correlate this to increase in rents. What correlates the most, right? Yeah. Right. So when you're trying to do a statistical correlation, you're trying to get as close to the number 1. Correlation of 1 is perfect correlation. Correlation of 0.99 is close enough. So what we found is the rents were most sensitive to jobs. So if an area, had job growth, it would immediately see rent growth. Home prices were very, very tied to population growth. So as more people moved in, the population would go up. And then incomes obviously would, it was tied to incomes. And all of this may seem fairly common. Like anybody listening would say, well, it's just common sense. More people come in, right? The question is not that this is common sense, because, if it was, then everybody would be successful at real estate. But millions of people lose money in real estate. It's about how much. What is the point at which, growth in prices goes from like this to like that? It becomes a hockey puck. What is that point? So in the US, we found that the population growth that is required to go from slow home price growth to fast home price growth is about 0.9 to 1.1% a year for population growth. For income growth, it's about 2.6, 2.7% minimum income growth, and then you start supporting that hockey puck growth. For job growth, it's about 1.7, 1.8% in job growth on an annualized basis. So what we were trying to find was the numbers, the point at which you go from slow to hockey puck growth, right? And those numbers obviously change every year, and we publish them every year on a website called multifamilyu.com. And that's what people have been using. So if you go to a website called
acquisition, right? It's also data to tell you when to get out.
It does, because at some point what you start seeing is that growth is slowing in a market, right? So that market's become very expensive, so less people are moving in. That market's become so expensive that less people can afford to buy. So everything basically starts to slow down. So of course, with data, you don't just track, when you want to get into a city. You also want to track, okay, when is everything slowing down and it's time to exit, right? And it doesn't always match up with your exit date, because you might still be in the middle of construction when that happens. So it's less of a perfect science. So we primarily focus on when is it time to get into cities, and should we be getting into big cities, medium cities, small cities? What makes the most amount of sense? Those are all the things that we are trying to figure out. So it's not as simple as there should be population growth in any city that you're investing in. It should be how much population growth. And that should be compared to all of the other cities. Like, for example, the UK is a much slower growing economy in terms of population than the US is. But the principle still applies. You're comparing, every major city in the UK to every other major city in the UK and trying to rank them and say, London's population growth is the highest, or this portion of London, the population growth is the highest. This is where we should be building, right? Or this is where we should be buying.
Now, a message I kind of got that came across looking at your website is that, this trust in data and technology, obviously being a technologist yourself, has kind of grown to the point where fundamentally it seems like data combined with AI and some other solutions you've got are kind of your main drivers to your decision. You kind of fundamentally, I mean, obviously, I'm sure there's a little bit of questioning with the data, particularly depending on the cost of the asset. But it came across on the website that really data and technology seems to be like kind of 90% of what determines, that identifies and determines whether an investment is right.
I wouldn't say so. I think that, no, I would disagree with that. I would simply say data often tells us which cities to focus on. So we basically, sort of eliminated certain verticals. So it's telling us, oh, right now multifamily is good, or industrial is good, or hotels are good, or retail is good. So now we start focusing on that vertical, right? Because we've done more than multifamily. We've done many other asset classes. And then it's like, okay, what cities and what states to focus on? Now we're there. Now we're looking at those. But beyond that, when we look at an individual deal level, a piece of land or a building that's already built that we're buying, I think that there's only so far that data can take you. Experience is very key. So I think that data accelerates, data focuses you, but I think in the end, there's the human element is still extraordinarily strong. And maybe 5 or 10 years from now, with the use of AI, I mean, our use of AI has become obsessive in the last year. We may actually get to the point that you're talking about, but I don't get the sense that we're there yet.
Yeah. And I think what's really interesting, what you talked about, is obviously geographical location. It's where those metrics hit your algorithm, or whatever you want to call it. And then, like you said, you will build depending on, if it's commercial or multi-home or apartments, whatever the data says. I think what's really interesting there, when I look at the UK market, you will find that the vast majority of property developers are quite geographically centered. Like, they will be a London developer, or they will be a Midlands developer, or a North developer. There aren't many, apart from a handful of really big boys, who are kind of look at the whole market. And then also over here, they tend to be specialist. You have commercial developers, industrial developers, residential developers. You have ones that build apartment blocks, one that builds small houses. And again, they tend to kind of stay in their wheelhouse. What's really interesting talking to you is you seem to take this overarching view that fundamentally real estate is real estate. Like, what it's classed as is fundamentally irrelevant, because you'll bring in the experts to deliver the technical build that meets the regulations and compliance and whatever relevant to that sector. But you will go, whatever, Boston multifamily housing is where the next big boom's going in, and that's where you'll direct your attention. But then the next one might be warehousing in Michigan or something. I don't know, whatever. But it sounds like to you, it's the location and the like classification of what you're building is relatively immaterial. It is just about
relatively, yes, because but keep in mind,
and what
yeah. So I think the word that you used, Kristjan, that is correct, is relatively, because it takes time to gain competency. For example, understanding how to buy, build, or manage warehouses is fundamentally different from something like student housing or senior housing, or things like that. So I think there are many things that we simply haven't done, even though we provide data on it on our website saying this is a very good thing to do, like industrial for, in the last 4 years. We've been talking about it, but we only did one industrial project because we simply didn't have the competency. So the data might say industrial is a better class than multifamily right now, but if you don't have the connections, the competency, the skill to underwrite, the skill to analyze, then you don't get too much into it. I regret not getting into industrial 4, 5, 6 years ago, because I was publishing data about industrial being a better asset class. Part of it was because of AI, right? So what's happening is new AI data centers, all of them are being built in warehouses. So the industrial asset class has seen, higher occupancy, higher rents, lower cap rates. So, all good things that are driving up the value of industrial real estate. And we were talking about it, but we didn't get into it because we didn't have the competency. So I think the word relatively is key, because you've got to have the competency to manage that asset class. You can't just say data says today industrial is better than multifamily, and all of a sudden I'm an industrial guy. Well, you're not, because you don't have the skill to understand that market.
Yeah, but surely that's where you can bring in expertise, right? I mean, that's kind of what agent consultants are there for. And again, like we
Or
said,
partners. In my case, I've partnered with people that have been doing industrial for a long time. That they build industrial for a living, and I'm like, okay, I'd like to work with you and learn from you.
You build good buildings, but I can help you identify better places to build them.
Exactly.
So,
or actually the other way around, where I use my data to say, right now, northern Utah is a great place to build industrial, and then I look for partners that are in northern Utah that build industrial, right? So what I'm doing essentially is I'm not looking for a partner that lives in Tennessee. I want a partner that lives in northern Utah and builds industrial. I want an introduction to those people.
All that sort of stuff and permits and
Exactly. I mean, so the data is helping me find the right partner in the right place.
So, because we're getting to the end of our time having a chat together. So, for like a UK landlord who's listening to this, what are your kind of key bits of advice where it comes to applying data to their kind of sourcing or decision process?
Well, the first thing I'd like to say, and this might make me unpopular with your landlords, is that I think that UK landlords need to be careful. When I compare the US landscape to the UK landscape, I urge caution. I urge that UK landlords should not make the assumption that the next 10 years of your real estate market are like the last 10 or 15 years. Obviously, enormous increases in home prices and also some fluctuations, some downward movements as well. But in general, it's fair to say significant upward movements, especially London Metro, right? I mean, the others have not been as impressive, but there's been, huge increases in prices. And I think in some ways, it's possible that landlords are thinking that may repeat or continue. And I think that when I look at the demographics of the UK and the challenges that the country is facing, there's significantly more challenges than my country.
I mean, there's little wage growth, which is the biggest problem here, because
it's wage growth drives everything, right? Because if you don't have wage growth, people will leave, right? And there's people leaving the UK. So from my perspective, what I would say is the data points me, and I'm not by no means an expert on the UK. I just study it because I'm Indian and there's a strong connection to England. And I look when I look at it, I go, here's what I say. Boy, I'm glad I'm not a landlord in the UK. And I think UK landlords need to use data to fully understand where there's population growth, where there's job growth, and also the quality of that job growth. Sometimes people are very basic in saying, well, this area is growing in jobs by 1%. But is that a warehouse job or is it a technology job?
Exactly. If you're
one tech job is equivalent to 5 warehouse jobs, right? So I think that it's very important that people understand the quality of jobs when they make bets. Also, I think that they need to understand that the next 10 years of landlording may not be as rewarding as the last 10 years, and they need to be careful about it. That's what I see. But again, not an expert.
And then for agents kind of partnering with entities like yourself, with individuals like yourself, what kind of things are you really looking for? What do you find are kind of the predetermining factors of who's a good agency partner, whether you're looking to sell off a development or have it let and managed for the next few years? What are the kind of precursors that kind of make or break an agent's bid to work with you?
In the US, this is very institutionalized. There's a company that everyone in our trade knows, 100% branding, called CoStar. So I can just simply go into CoStar and I can say, okay, I'm looking to sell my building in Atlanta, 250 units. I can click on CoStar, I can click on a particular tab, and I can basically just say, give me a list of everybody that's sold a building here in the last year. And then I just sort it by the guy or the agent that has sold the most over the last year. And I give the business to them because they've got the biggest database. They've got the biggest buyers. They've got the biggest check writers. And I want people to fight over my building. And so from my perspective, I mean, that, and CoStar is, universal. I think what I mentioned here is something that almost everybody does. So you basically give the agent with the biggest network and the biggest track record. And this information is very easily available for anyone that has a CoStar subscription.
Yeah. See, interesting in the UK, I mean, our marketplace is completely the opposite. It's in fact the opposite to most industries, even in the UK, where typically it's 80% corporate, 20% independent. But the UK real estate market is completely the opposite, 80% independent, 20% corporate. So it's it's a huge dissemination. And that kind of data, a lot of because the marketplace is a lot smaller, you find it quite hard to find accurate data on the genuine performance of agents. There's a lot of claims put out there, but in terms of data that is really transparent and verifiable to an open market investor, quite difficult to pick.
Well, what I would say is, it sounds like there are technology opportunities there for tech people to basically build more software. And I hear that, especially in London, there's a lot of prop tech or property technology startups that are looking to sort of you follow the US model and aggregate the data together and make it available to investors and to anybody looking to make a decision. So it feels like the market there will mature as more software comes in.
It's getting there, and it's getting better. And obviously, the thing we have to remember, the UK is very influential globally, but we are fundamentally an incredibly small country with not that many assets. Yeah. So comparing it to a marketplace like the US, which is just vast, it's interesting. Well, Neal, that's been a fascinating chat. I think we've kind of run out of our allotted time for today, but it's been an absolute pleasure having you on. Great to have my first international person on the call. This has been great. And I'd love to maybe reach out to you in kind of 6 to 12 months time and kind of check in and see where that journey's gone.
Sounds good. Well, thanks for having me on the podcast. For those that want to learn more about our data methodologies, check out multifamilyu.com/club. That's multifamily followed by the letter u.com/club. We store all of our data there. We have no subscriptions, no upsells. It would be lovely if someone in the UK was to basically take what we do and apply it to the UK market and let me know about it. That would be, a fabulous thing for me to know about.
There we go. There's a challenge. So if you're listening to this, get on, check out that data. And if you think you can leverage that into the UK market, do, but get in touch. Contact Neal, tell us what and how and how that works for you. Neal, thank you so much for your time today. Everyone, thanks for listening. We'll be back soon. Cheers, Neal. All the best.
Thanks for having me on.
Cheers. Bye-bye.